Respected judges of the Chicago Quantitative Alliance. We are Rensselaer Team 1 and I am Chintan Dave, the Chief Investment Officer of the team. Our academic advisor is Professor Janika Singh and our industry mentor is Mr. Pankaj Patel. Let me take you through our investment philosophy and investment process. It's true that no portfolio can succeed without a sound investment philosophy. Let us view our investment philosophy. First, we had to analyze the outlook of the US economy for the first half of 2017 and narrow it down to first quarter of 2017. After we had the outlook of US economy on hand, we had to analyze which industries were going to perform well and which industries were going to perform not so well in the first quarter of 2017. We also had to allocate our portfolio weights to different industries so as to achieve the benefits of diversification and to benefit from the industries which were going to have superior returns under different administrations. After we were done analyzing the industries, we had to handpick the companies based on fundamental analysis and technical indicators. It's true that value stocks tend to outperform growth stocks in the long run, but the investment cycle was not a long run and hence we had to focus on growth stocks as well. Also, we had minimum standards for investment, meaning that we did not invest in certain companies such as penny stocks. Let me take you through our investment process now. After analyzing the companies fundamentally, we did a technical analysis so as to determine the point of entry and point of exit in a particular company. We also had a special team monitoring the news and specific guidances under the Trump administration so as to achieve the benefits of what is popularly known as the Trump bump. After we had decided the securities, we had to run them through a mean variance optimizer to allocate optimal weights so as to achieve the benefits of maximized returns with minimum risk and to maximize our Sharpe ratio. After running them through a mean variance optimizer, we had to continuously monitor the portfolio so as to not let the volatility exceed our appetite. For the purpose of our investment process, we used Bloomberg and proprietary software developed by Professor Janika Singh. Thank you.
As the main investment strategy we did are value investing and momentum investing. First, for value investing, what we did is based on buying stocks which appears cheap when the issuer's current earnings and assets are taken into account. We want to find out the stocks that are undervalued. This kind of stocks usually present irrationality, such as lower than average PB ratio, lower than average PE ratio, and a higher dividend yield. In the case of good macroeconomic environment, we carefully study the financial statement of companies, industry prospect, and the company's industry status. After analyzing the comprehensive analysis of the company, we predict their prospect for development and buy the stocks that we think will perform better in the future. For example, we buy MasterCard because the earnings estimate were $0.85 per share, and the expected number is $0.88 according to our model. And it turned out that our prediction is right. We actually win some money on this investment. The second strategy is momentum trading. We look to take advantage of upward trends or downward trends in the stock's price. Momentum trading carries with a higher degree of volatility. We use a variety of technical tools to do this investing. For example, the moving average, oscillator, and the relative strength.
So after the fundamental analysis, we decided several stocks. And now I'm going to use the technical analysis to determine the long point or the short point. Basically, we are going to use the SMA, MACD lines and the RSI indicator. So as for the SMA lines, we choose the 50 days and 200 days of SMI based on the condition that we have a short trading period, so about a month. So in this condition, when the 50 days of SMI go above the 200 days SMI, lead ahead the 5 to 6 trading days, we are going to long the position. And conversely, we are going to short. In the example of our best performance, the JPM, we bought JPM at 64.48, just 7 trading days before the 50 days SMI go above the 200 days SMI, and this is a successful analysis. And as for the MACD lines, when the MACD lines cross above the zero line, we take it as a bullish signal, which means we have to consider to buy. And as the MACD lines go above the zero line, we take it as a bearish signal, which means maybe we should sell. So as this example, we can see that we bought a point just as the MACD line goes across the zero line, which actually is a good point. And as for the RSI indicator, we plan to magnitude the gain and losses over a specific time period of time. And we decided to choose the speed and the chain of movement of a specific stock of our trading asset. And when the RSI indicator above the 70, we think we should overbought. And when an indicator beneath the 20 point, we think it is oversold. But based on our own portfolio condition, we think we should change the point to 75 and 30. And look at the worst performance of our example. This is because we didn't follow the rule we said before, so we make a bad decision. And this is a brief introduction of our technical analysis.
After determining the stocks we want to invest in, the next step is to use a quantitative method to determine the optimal weights for each one of them. The strategy here is the mean variance optimization model introduced by the Nobel laureate Professor Harry Markowitz in 1950s. We're going to construct our efficient frontier from our stock pools, and based on that, to make our optimal decisions. Here is our model. As you can see, the objective function consists of three parts. The RP is the absolute return of the portfolio, and this ratio is about the measure of the Sharpe ratio of the portfolio, and the TC is a transaction cost. As for the constraints, the AR is a vector consisting of the expected returns of each stocks, and the W is the weight for the stocks, and the COV, the curve, is a variance-covariance matrix for each of the stocks. And the following constraints are about the cash requirements, because we only have less than 5% cash at hand, and the dollar neutral and the beta neutral. And this table summarizes the symbol, the financial meanings, and the mathematical expressions used in our optimization models. So after we investing our money into the market, here comes the question. What we should do if some bad scenario happens? For example, what we should do if the portfolio's beta exceeds the required limits. Then you're right, we're going to rebalance and track the portfolio along the computation. And here comes the model for the rebalance. We still use a quantitative method, that is the optimization model. And here the objective function is about the volatility of the portfolio. And the constraint is still about the cash requirements, the dollar neutral, and the beta neutral.
I'm going to talk about the overall performance and returns contributions. That's the historical performance of our portfolio. We can see that our portfolio suffered great loss due to the election of the president. We have some good profits on the long side, while we suffered more on the short side. After proper rebalance of our positions based on the volatility and some fundamental information, we made some profits in December. However, because of the rise of the interest rate by Fed, our portfolio decreased for a while, and we managed to earn profits by rebalancing. That's the sector contributions. We can see that due to the new policy of President Trump, the banking industry has a dramatic increase, which has the highest return of 1.47%, while the healthcare has lost about 1.5%. Volatility is also a very important factor that is needed to include into our strategy. Once we find out that the returns turns to decrease and volatility tends to increase, we will know that there's something wrong with our portfolio and strategy, and we try to rebalance it by getting rid of the stocks with high volatility. From the figures of volatility contributions, we can see that the volatility contributes both positive and negative returns, and we try to make our portfolio less volatile.
I'm going to demonstrate our best performance and worst performance in our portfolio. Our best performance is JP Morgan. And the JP Morgan is a 4.87% of our total portfolio, and we gain 28.79% of our total return. And we made a long decision based on three factors. The first of all is that the JP Morgan offered out a good third quarter result 2016, with the core banking performed better than expected, and is have a spike with the good results in trading and iBanking. And what's more, JP Morgan's loan growth continues to impress, and the bank's stakes continues to grow in the CNR, CRE, and mortgage lending. And what's more, from the regulatory standpoint, the combination of Trump in White House and the Republican control of the houses in the Congress are good for banks. And what's more, the Trump's new economic policies are good, are likely to result in the more banking land and higher interest rate and a higher inflation, which will lead to the loans growth. However, our worst performances is HRI, and we lost 26.87% of our total return. And on the basis, we think that it's an inferior company relative to the industry leaders, such as the United Rentals and the Sunbelt Rentals. And what's more, the headwinds is exposure to the oil and the gas industry also leads us to make this decision to short the HRI. And from the financial performances, we can see that the EBITDA for the HRI is the smallest one among the 3 largest companies in this industry. But however, we made a wrong mistake.